Hello everyone, my name is Murtaza Quaid and I welcome you all to this lecture on IFRS 7, Financial Instruments Disclosures. Today, we are going to break down this standard in a way that is easy to understand and also see why it is important for companies with financial instrument. Now, before we dive into the details, let's get one thing clear. While IFRS 9 is the main standard dealing with the accounting for financial instrument, IFRS 7 focuses on something different, that is disclosures. This standard is less about how to account for financial instrument and more about informing the readers of the financial statement. Well, what does IFRS 7 cover? IFRS 7 prescribes all the disclosures related to financial instruments that companies need to include in their financial statement, whether in the notes or sometimes on the face of the statements. Essentially, IFRS 7 ensures that anyone reading the financial statements get a full understanding of the company's financial instruments, especially their significance and the risk they carry. Let me give you a bit of history on IFRS 7 before we go any further. IFRS 7 was originally published in August 2005 and became effective from 1st January 2007, replacing the old standard IS 30. A major revision happened in 2009, right after the global financial crisis began. Investors started demanding more information about the financial instruments that are held by the banks and the companies. And finally, with IFRS 9 becoming mandatory from 1st January 2018, several amendments were made to IFRS 7 to align it with the new requirements under IFRS 9. Now, let's discuss what is the objective of IFRS 7. The main objective of IFRS 7 is to prescribe certain disclosures about financial instruments in two key areas. Number one is the significance of financial instrument for an entity's financial statement. This means that the company has to disclose how important financial instruments are to its overall financial position and the performance. Like the company will need to show how these instruments affect its balance sheet, that is financial position, or profit and loss, that is performance, and cash flows. And number two, the nature and extent of risk arising from the financial instrument. This is where company disclose both qualitative and quantitative information about the risk associated with their financial instruments and crucially how they are managing those risks. We will dive into these risks a bit later. Now, who does IFRS 17 apply to? Listen carefully. Any entity that holds financial instruments needs to comply with IFRS 7. There is no exception when it comes to the types of entity, whether it is a bank, a manufacturing company, or a tech startup. If you have financial instrument, you need to disclose information in line with IFRS 7. However, there are some exceptions based on the type of instrument. Disclosure about subsidiaries, associates, joint ventures, insurance contract, share-based payments, employee benefit plans are guided by other standards and they are not covered by IFRS 7. Okay, now, why are these disclosures important? Look, financial instruments are not only significant in terms of their value, but they also carry risk that can affect a company's future performance and stability. Investors, analysts, and other stakeholders need to know how material the financial instruments are, how they impact the company's financial performance, and what risk the company faces in relation to these instruments and how well they are managing those risks. We will dive deeper into these disclosures in the following sections, including practical examples to make it easier to understand. Alright my friends, now let's talk about the significance of financial instruments and the related disclosure under IFRS 7. When you have financial instruments, you need to provide certain disclosures to help users of the financial statement understand whether these instruments are significant to your financial performance and financial position. These disclosures are divided into few groups, and I'm going to give you a quick overview of each. Listen closely, because understanding this will help you grasp the key points without getting stuck in unnecessary details. The first group of disclosure is related to the statement of financial position, or as we often call it, the balance sheet. Okay, now, what do you need to disclose here? You need to provide detailed information about the carrying amount of your financial instrument, broken down by categories. For example, you need to show financial instruments measured at fair value through profit and loss, any reclassification of financial instrument, and any information about collaterals you have pledged or received. These are just few of the many disclosures that relate to the balance sheet. And while we won't go into every details right now, just remember that this section covers everything that gives user a clear picture of the financial instrument you hold. Next, we have disclosures that relate to the statement of comprehensive income. In other words, your profit and loss statement. Here, you need to show a breakdown of your gains and losses from the financial instrument as well as information about it. Interest income and interest expense, fee income and fee expense, and any impairment loss related to your financial instrument. By providing these breakdowns, you are giving users of the financial statement a clear view of how financial instruments affect your profitability and the overall performance of the company. Okay, now let's move on to a few special disclosures related to your accounting policies. Here, you need to explain how you handle certain accounting treatments. For instance, you will need to disclose the criteria you use for designating financial instrument at fair value through profit and loss, whether you apply trade date or settlement date accounting, and other specific accounting treatments related to your financial instrument. These disclosures give users insight into how you manage and account for financial instruments, which can affect how they interpret your financial results. Then, you also need to provide disclosures related to the fair value of all your financial instruments, even though they are measured at amortized cost. Well, why? Because fair value are crucial for the users to understand the true value of your financial instruments that you are holding. You must disclose how you determine the fair value, the major assumptions and the information you used, and if you cannot determine a fair value for some instruments, you also need to explain why that's the case. Finally, if you apply hedge accounting, there are specific disclosures related to your hedging activities. You will need to provide information about your risk management strategy, future cash flows and their timing, any uncertainties related to your hedge positions, and the overall effect of hedge accounting on your financial statements. By making these disclosures, you are helping users understand how your hedging strategy work and how they impact your company's risk management and the financial performance. So let's summarize, my friends. These disclosures are essential because they show the significance of your financial instrument. You will need to provide information related to: number one, the carrying amount and the details of your financial instrument on the statement of financial position. Number 2, breakdown of gains, losses and expenses on the statement of comprehensive income. Number 3, accounting policies you apply to financial instruments. Number 4, the fair value of all the financial instruments. And number 5, the details about hedge accounting if applicable. All of this gives user a comprehensive picture of how financial instruments affect your company's financial position, performance and the risk exposure. Alright my friends, let's move on to the second category of disclosures required under IFRS 7. The disclosures related to the nature and extent of risk arising from the financial instrument. These disclosures are crucial for helping users of the financial statement understand the risk your company is exposed to and how those risks are being managed. Listen carefully. When it comes to financial instruments, there are 3 main types of risks that you need to disclose. First is credit risk, the second is liquidity risk, and the third is market risk. We will go through each of these risks one by one and I will explain them in simple terms. Let's start with credit risk. This is the risk that one party to a financial instrument will cause a financial loss to other party by failing to discharge an obligation. Okay, now think of it like this. Credit risk is the risk that you won't be able to collect your receivable because your customer cannot pay. Maybe they are facing financial difficulties or even bankruptcy, which means you won't receive the cash you are owed. So in simple terms, credit risk is all about the uncertainty of whether your customer will pay their bill. Next, we have liquidity risk. This is the risk that your company will face difficulty in meeting its obligations related to the financial liabilities. In other words, it is the risk that you won't have enough cash to pay your debts when they are due. Let me make this clear. Liquidity risk is about the availability of cash. If your company is short on cash, even temporarily, you may struggle to settle financial liabilities like loans and payable. It is very practical risk that can affect any company, even if they are profitable on paper. And finally, we have market risk. This is the risk that the fair value or the future cash flows of a financial instrument will fluctuate due to changes in the market prices. The market risk can be further broken down into 3 separate types of risk. First is currency risk. This risk is all about fluctuations in the foreign exchange rates. If your company deals in foreign currencies, you are exposed to this risk. Second is interest rate risk. This risk relates to the fluctuations in the interest rates. Changes in interest rates can affect the cost of borrowing or the returns on investment. And the third is other price risk. This category includes risk related to commodities prices, equity prices, and other market-driven factors that could impact the value of the financial instrument. Now, when you are reporting on the nature and extent of risk, IFRS 7 requires both qualitative and quantitative disclosures. Let's break this down. Listen to me. Qualitative disclosures are essentially a narrative description of the risk. You are writing a story, a detailed explanation about each type of risk and how your company manages them. There is no need to include specific numbers here. Just describe the risk and the strategies you use to handle them. For each type of risk, whether it is credit risk, liquidity risk, or the market risk, you need to provide the following qualitative information. Number 1, how the risk arises. Here, you need to explain where the risk is coming from. For example, if your company has foreign currency exposure, that's where your currency risk come from. Number 2, objectives, policies and procedures for managing the risk. Here you will describe your risk management strategy. What are your goals? What policies do you have in place? And how do you manage these risks? And number 3, methods for measuring the risk. Finally, you will explain how you measure and assess the risk. Are you using specific models or tools to evaluate the potential impact of the risk? So qualitative disclosures are all about telling the story of your risk management. You need to describe how the risk arises, how you manage the risk through policies and procedures, and how you measure the risk. These disclosures gives users insight in your company's risk exposure and the strategies that you have put in place to mitigate those risks. Alright my friends, now let's dive into the quantitative disclosures that are required under IFRS 7. This is where you will need to get into the numbers and the calculation behind the risk associated with your financial instrument. The standard prescribe specific quantitative disclosures for each type of risk. So let's break it down on the 3 main risks that we talked about earlier: credit risk, liquidity risk, and the market risk. For credit risk, you need to disclose several key pieces of information, mainly around your credit risk exposures. These disclosures help user understand how exposed you are to the risk of non-payment by your counterparties. Here is what you need to disclose for credit risk. Number 1, credit risk exposure. This includes the amount of your financial assets that are exposed to the credit risk. Number 2, main collaterals and credit enhancements. If you have any collateral or guarantees in place to reduce your credit risk, you need to describe them. Number 3, credit risk management practices. Explain how you manage credit risk, including any policies or procedure in place. Number 4, credit quality of the financial asset that are not past due and not impaired. This includes things like credit ratings or other indicators of the credit quality. One of the most important disclosure here relates to the expected credit losses. You will need to provide information about amounts arising from the expected credit losses, and this is typically done using a tabular format. For example, when disclosing trade receivable, you might use a provision matrix to show how you calculate expected credit losses based on different factors like the aging of the receivable and the historical default rates. For liquidity risk, the focus shifts from financial asset to financial liabilities. Liquidity risk is all about your ability to meet your obligation as they come due. So the standard requires you to disclose a maturity analysis of your financial liabilities. Here is what you need to disclose for the liquidity risk. Number 1, maturity analysis of the financial liabilities, showing the remaining contractual maturities. This means you will need to break down your liabilities by the due date, showing when each liability is expected to be settled. And number 2, how you manage liquidity risk. Explain how you ensure that you have enough cash or liquid assets available to meet your obligation as they fall due. Listen carefully. The key point here is that credit risk relates to your financial asset, while the liquidity risk focus on your financial liabilities. When presenting the maturity analysis for the liquidity risk, you will need to group your financial liabilities by different classes and show when they are due. For example, you might break down your liabilities into time bands like due within 3 months, due within 1 year, and due within 2 to 5 years. It is up to your judgment to decide how detailed you want to be, but the idea is to give a clear picture of your liabilities that when they are needed to be settled. Now, market risk disclosures can be a bit complex. You need to present a sensitivity analysis for each component of the market risk: interest rate risk, currency risk, and the other price risk. Sensitivity analysis shows how your profit and loss and equity would be affected by the changes in the relevant market variable, such as interest rate, foreign exchange rate, or the commodity prices. For example, if the interest rate increases by 1%, how would that impact your profit and loss and equity? That's what you need to disclose in the sensitivity analysis. You will be simulating different changes in the market conditions and analyzing the impact of those changes on your financial performance. Alternatively, instead of performing a basic sensitivity analysis, you can also use a more complex method called the value at risk (VAR). Value at risk takes into account the interdependence of multiple variables. For example, you might assess the combined effect of changes in the foreign exchange rate and the interest rate on your financial instrument. Okay, now, it might seem like there is a lot of work involved in preparing these disclosures, but let me give you a few tips to make the process easier. You can present your quantitative disclosure as an integrated package. For example, you can create a single table that covers both the concentration of risk and the credit risk exposure. This makes your disclosure more streamlined and easier to understand. Then, always consider materiality. Include all the significant and material items, but don't overload your readers with insignificant details. Focus on what is important and avoid drawing your audience in a sea of unnecessary information. And finally, when presenting these disclosures, make sure to group your financial instrument into appropriate classes. Remember, these classes are not the same as the categories under IFRS 9. Classes are more detailed and specific. They are like subcategories that provide better insight into the nature of the risk. So to wrap up, when you are preparing your quantitative disclosure, focus on the following. For credit risk, provide details on credit exposure, collateral, and the expected credit losses. For liquidity risk, present a maturity analysis of your financial liabilities. And for market risk, provide a sensitivity analysis or value at risk analysis to show the impact of market fluctuations on your financial instrument. Well, that's conclude our today's discussion on IFRS 7, and I hope this gives you a clear understanding of the disclosures that are required under IFRS 7. With a bit of careful preparation, you can present these disclosures in a way that is both informative and easy to follow. We will conclude today's section here. Thank you for your attention.